Good morning, everyone. I'm Joyce Barrett with Heritage Ohio, and welcome to Day 10 of the Heritage Ohio Virtual Conference 2020. I want to thank Sandvik Architects, who's the title sponsor for the conference, and Kuhn Restoration for being conference sponsors. Today's session is sponsored by the State Historic Preservation Office, and they are also sponsoring the AIA credits. There's 1.5 HSW AIA credits available. If you need or want those credits, please email our office manager at officemanager@heritageohio.org. He will put the learning objectives in the chat box, and please send him that and he'll get the certification. So this morning I'm delighted to present, have a panel to talk about the historic tax credits, new market credits, and opportunity zones in the COVID era. And Gordon Goldie from Plant Moran is going to kick off the session. So Gordon, I'll hand it over to you to do introductions.
Great, thanks Joyce. So my name is Gordon Goldie. I'm a partner with Plant Moran's Housing and Community Development Solutions Group, based here in the Detroit area, but we do a lot of work in Ohio and have been lucky enough to be chosen to present at this conference for several years in a row. We put together, I think, a strong panel here to share a lot of information with everybody about the incentives that are often used in these historic rehab projects. So I personally, as part of our Housing and Community Development Solutions Group, spend virtually all my time helping clients put together financing for real estate projects that utilize incentives, including the historic credit and opportunity zones and some of the other incentives we're going to be talking about here today. Maybe before we get into some of the meat of the discussion, let me kick it over to Lucas to introduce himself, and then Marie.
Thank you, Gordon. Good morning. I'm Lucas Witters. I'm an income tax associate with Baker and Hostetler LLP. It's a firm with about 900 attorneys nationwide. I sit in the Cleveland office along with about 10 members of a team that does a lot of tax advantaged real estate development, I would call it, and I'll go through some of the incentives we use in this presentation.
Thanks, Lucas. I'm Marie Hickel. I'm a vice president at PNC in our Tax Credit Solutions Group, responsible for specialty tax credit investments, specifically the new market tax credit and the historic tax credit, our origination activity within our PNC Tax Credit Solutions Group. I work with CDEs, partners, lenders, developers, and work on the deployment of our own new market tax credit allocation. I formerly was at Bank of America doing new markets historic originations, and then I began my career as a public accountant at another accounting firm. So PNC, we are an active investor in the historic realm, and we are excited to be here.
Great, thanks. So maybe before we get into the detail of the discussion, just give you a quick overview of the agenda. So I'm going to be starting out covering an update on a bunch of technical topics, hopefully not too technical, that have affected the historic credit in the past year. It's been a very busy year from a standpoint of updates on the historic credit. A lot of years are very quiet, but this has been, obviously, with COVID and the economic recovery and stimulus and everything, there's just been a lot going on. And so I just wanted to kind of give a high-level overview of a lot of the topics that if you haven't been paying attention, you might have missed over the last year that affect the historic credit. Also going to be given an overview of opportunity zones, which is a new incentive that was created as part of the 2017 tax reform. And some brief updates on that. There's been some new regulations issued in that program over the past year that have really kind of solidified how that program works. And so I think that hopefully we're going to be seeing a lot of more use of that, including for projects that involve historic rehabs. And then Lucas is going to get into a bunch of the different state and local incentives in Ohio that are available for these projects, and also a high-level overview of the federal new markets tax credit, which Marie mentioned that PNC is involved in. And then Marie's going to get into kind of her perspective as a tax credit investor, on these transactions, particularly in today's age of the, the economic recovery post-COVID or after the COVID pandemic and such, and how that's affecting the industry and various things like that. And hopefully we'll get some questions, have some time at the end to, actually we'll try to save time at the end of each of our sections to answer questions. So feel free to type in questions and we'll cover those as we go at the end of each section. So that's kind of a high level overview. I'm going to start by sharing my screen here and get into, hopefully, once I get these to advance. The first topic I just wanted to cover, just high level, is just kind of where incentives fit into the financing for a typical real estate project. So this chart here, and I know the some of the fonts might be small, but hopefully the chart kind of tells the picture. A typical real estate project is financed through a mix of first mortgage financing along with owner equity and in some cases a mezzanine loan or preferred equity. But in a lot of cases, the amount that you can borrow on a first mortgage and or that owners are willing to put in order to generate the rate of return they need is not sufficient in order to be able to get a project done. And so that's where incentives come in. And so the incentives really, to a large degree, kind of fill that gap that might be needed, because obviously, whatever a project costs, you're going to need to come up with that much money. And so if you can't come up with enough money through the traditional financing sources, you might need incentives in order to be able to fill that gap. So that's what we're going to be talking about here today, is a lot of those incentives that people use on these historic rehab projects to fill that gap in the financing structure, or the capital stack, as some people refer to it as. So I'm going to be starting out talking about, like I said, some news that is worth sharing in the historic credit front. This somewhat presumes that you have a general understanding of the historic credit, and I know there was a great session yesterday morning that covered a lot of those details. But in any event, again, feel free to ask questions after this section if you'd like some more background or detail on some of these things. So the first thing I just wanted to mention is that there are some bills that have been introduced to improve the credit. And I do want to emphasize that they're just bills at this point. They have not been passed. And so don't get too excited about it. But to the extent that some of these features are appealing to you and or projects that you're working on, I guess I would encourage you to contact your federal representatives, House of Representatives and or senators to encourage them to enact this legislation so that it does become law and that we can improve the credit going forward. So the first slide here is a bill that was introduced late last year in both the federal House and the Senate called the Historic Tax Credit Growth and Opportunity Act, also referred to as the HTC GO Act. And so this has been an effort that's been in the works for several years, trying to get enough sponsorship to get it introduced and hopefully somehow attached to some other legislation that might enable it to get enacted. But at a high level, what it does is that, number one, it helps make deals that are smaller more easier to use the credit. So for one thing, it increases the credit for smaller deals from 20% to 30%. Obviously, that could be a big help, particularly to the extent there's administrative cost of getting a deal done that makes it hard for smaller deals to work. And then secondarily, the House version of the bill actually makes the credit transferable via a certificate, which obviously would simplify the process for smaller projects. Again, that's only for smaller projects, and it's only in the House version of the bill, but obviously that would be a nice feature if it could get enacted. A couple other things they're looking at doing would be eliminating the basis adjustment that takes place when you claim credits. So for example, if you had $1 million of qualified rehab expenditures, you get a 20% credit, so $200,000 credit. You'd have to reduce the depreciable basis of the property by that $200,000 credit, and you would depreciate the other $800,000 over the life of the property. Well, without the basis reduction, you could depreciate the entire $1 million. So you could claim the $200,000 credit and depreciate the entire $1 million instead of only $800,000. So that obviously would create more tax benefits to the owners and make the credit more valuable. They're also looking at reducing the substantial rehab test. So right now you have to spend more money rehabbing the building than your basis in the building at the beginning of the rehab. And so they're talking about reducing that to 50% of your basis. But again, this is just a bill. It's not the law at this point. And they're also trying to ease some of the tax exempt use restrictions that exist, currently exist. Kind of piggybacking on that, there was a recent bill that was passed as part of this effort to put more stimulus out there called the Moving Forward Act. That bill passed the House recently, but not the Senate. And it basically includes all the provisions I just discussed at as part of the HTC Go Act. It also temporarily increases the historic credit for all projects to 30%, which then phases back down to 20% based on the table that you see on the chart there. The other thing that it does, in addition to those two things, is that it makes it possible for public school buildings to use the historic credit, which they currently wouldn't qualify for, to the extent they're continued to be used for public schools. So that would obviously be nice if that could get enacted. Again, this would be something that would be worth doing some grassroots lobbying for, particularly if you've got projects that would benefit from these provisions. So I encourage you to look into that and contact your representatives, particularly your senators, Republican senators particularly, if you want to try to encourage them to pass this legislation. So now on to things that actually have happened. So over the last several months, there's been quite a bit of guidance come out on the historic credit. This particular page is covering a regulation that came out a couple of months ago, basically to clarify a change that was made to the statute back when tax reform was enacted in 2017. So as a reminder, prior to tax reform, when you did a historic rehab project and placed it into service, you could claim the entire credit related to that project at the time you placed it into service. But the tax reform caused you to now have to spread that credit over a 5-year period. The other thing that happened as part of tax reform is it took the 10% credit away. So there used to be, and to some extent for grandfather projects, there still is a 10% credit for buildings that are not historic, but they're old. They're built before and placed service before 1936, non-residential buildings. And so that credit was taken away from us as part of the tax reform. And so with that background, there was some question about how the rules worked in terms of calculating the credit. Is it prorated monthly over the 5-year period, or is it annually? And there's also some questions about how the fact that the credit's now spread over 5 years affects some of the other aspects of the program, like the basis reduction we just talked about, and the recapture of the credits, because the credits are subject to recapture for a 5-year period. And so in general, the regulations clarified that the credit is still determined in the year that the project and or QREs are placed in service, and it's just spread over 5 years. So you do not have 5 separate credits and or 5 separate recapture periods. You just have one credit. It just happens to be claimed over 5 years. And so you got one recapture period, and all the basis reduction occurs in the year the project is placed in service. So basically, with respect to recapture and the basis adjustment, they're confirming that there's no change in the law. The only really effect of the 5-year credit is that you claim it over 5 years. It doesn't change any of these other things. So that was helpful clarification, because there was some ambiguities as to how that works. With the change in the law. They also include some examples in the regulations to make it easier to understand how these rules work, particularly in a situation where you've got a recapture of a credit that's claimed over 5 years, because that can be kind of complicated. So in any event, that was very helpful clarification that we got just a few months ago. And then there's also some clarification that we got here related to kind of economic impact of the COVID-19 pandemic. So a lot of projects were put on hold or delayed as a result of the pandemic and some of the shelter-in-place restrictions that were put in place in various states. And so there was a big concern in the historic credit community that could cause some negative implications to projects that were underway already. In particular, the two that were noted and thankfully we were granted relief related to is the substantial rehabilitation test and the grandfather transition rule related to the tax reform impact. So just briefly, the substantial rehab test, the concern there was you've got to spend more money during a 24 or 60-month measurement period on qualified rehabilitation expenditures than your basis in the building at the beginning of that 24-month period. And so, if you had a project that got delayed, maybe because of the shelter in place or for whatever reason as a result of the pandemic, then the concern would be that, well, maybe you're not able to spend the money quick enough to be able to pass that test. And so what they've done is they've granted kind of an extension and said that if your 24 or 60-month measurement period ends anywhere between April 1st of 2020 and March 31st of 2021, they're going to extend your ending date of that measurement period to March 31, 2021. So basically they're giving you more time to spend the money to pass that test, which obviously is helpful. And secondarily, and very similarly, there were some transition rules in the tax reform that allowed projects that were already kind of in the works before tax reform came into play to either claim their credit over 1 year instead of 5, or to qualify for the 10-year credit still under these grandfather transition rules. And one of the provisions of those rules was that you basically had to have your substantial rehab test measurement period end by June 20th of 2020 if you had a 24-month measurement period. And so what they've done is they've extended that basically to March 31 of 2021. So basically they're giving you more time to pass the substantial rehab test and qualify for the grandfather treatment so that you could still claim your credit over 1 year and or with the 10% credit, claim the 10% credit, as opposed to alternatively claiming the credit over 5 years instead of 1, or not getting any credit under the 10% credit because that credit goes away unless you're grandfathered in. So again, this was very helpful relief that we received just recently. The final topic I just want to talk about from the historic credit update is the CARES Act. This gets a little technical, but so I apologize in advance for that. But there was a lot of talk about the CARES Act, and I'm only going to cover one aspect of it, one that might not have gotten a lot of press. But this is the act that introduced the PPP, Paycheck Protection Program, loan program that got a lot of press and a lot of small businesses used. But one of the things that happened in the CARES Act is they corrected a technical glitch that occurred when tax reform was enacted in 2017. So when they enacted tax reform, they intended to assign a 15-year depreciable life to what's referred to as qualified improvement property, and that's generally it's non-structural improvements to a building that has at least 20% of the rent coming from commercial tenants. It was maybe in its simplest form, you could think of it in terms of tenant build-outs for commercial space, but it's actually broader than that, particularly for a mixed-use building. It includes things like HVAC and plumbing and electrical and other things like that. So it's more than just the build-out. So it can be a fairly substantial portion of the project, but for some reason, due to the fact that tax reform came together overnight, basically they missed assigning a 15-year credit to this property, and it ended up with a 39-year life. And but it was clear that the intent was to make it 15-year. They just didn't put the language in the act to enable it to happen. So what they did was they corrected that as part of the CARES Act, and they did it retroactively. So tax reform was enacted in 2017. And so they basically changed the life of the qualified improvement property to 15 years retroactive to 2018. And so a lot of people had already filed tax returns for 2018 or even 2019 using a 39-year life for this property. And so in those situations, you really do need to go back and look at correcting that basically. And there, as outlined kind of on the bottom of the slide here, I'm not going to get into the technical details here, but there's basically 3 options for correcting the life of that property from 39 to 15 years. You could either amend the return, you could supersede a return if it hasn't been, if the deadline hasn't passed yet, the ultimate deadline for filing that return hasn't passed yet, or you could correct it in a subsequent return by filing Form 3115. And there are some kind of strategic, thoughts that need to go into which of those is the best strategy for any given fact pattern. So, I'd encourage you to make sure if you've got a project that has some of this qualified improvement property in it that was, filed its return already for 2018 or 2019, to make sure you consult with your tax advisor about the best approach for correcting that. But the reason why it's important to correct it is that the 15-year property is eligible now for bonus depreciation, meaning you can deduct 100% of that cost when you place it in service. If you, and by the way, you're sort of deemed to claim the bonus depreciation unless you elect out of it. And the problem is if you claim bonus depreciation, or you're eligible to, and you don't elect out, then you can't claim historic credits on those costs, because you can only claim historic credits on costs that are not subject to accelerated depreciation. And obviously bonus depreciation is as accelerated as you could possibly get from an accelerated depreciation standpoint. So if you want to be able to claim historic credits on the cost, you have to elect out a bonus depreciation. And so it's very important, if you've got a project that's in this situation where you've got this qualified improvement property, to make sure that you go back and correct for it and make the election out of bonus depreciation, or else you're not eligible to claim historic credits on those costs. So that's probably the most important point to make with respect to this particular topic. So anyway, I will, that kind of concludes the technical updates of the session and our discussion on historic credits. But again, happy to take questions on that or any other matters related to the historic credits here after this next section. So the other topic that I wanted to cover is opportunity zones. And so I think last year we did an overview on opportunity zones, and I'm going to kind of go through that again here just to refresh everybody's memory, and then kind of intersperse some updates that came out of the regulations that were issued in December. So we got 550 pages or so of final regulations in December of 2019 related to the Opportunity Zone program, and so obviously that there's a lot to sift through there, but and I'm certainly not going to try to cover that, but the most important kind of message related to that is that basically we have all the final rules now. And so the program was enacted with tax reform at the end of 2017, and was operating for several years without really people knowing what the final rules were. And so now that we have the final rules, hopefully there's really no excuse. People really should know how the program works, and there's still some ambiguities, but much less than there was previously. So the program hopefully is workable, from that standpoint. And they really have done a good job of trying to be taxpayer friendly and implementing these rules. And a lot of the guidance that came out in December was taxpayer favorable and made the incentive even more usable than previously thought. So that was good news to everybody. But in any event, from a big picture standpoint, the general idea was to create an incentive to encourage people to make investments into low-income census tracts. So the incentive is, and I've got a map of Ohio here I'm going to show at the end of the session here, but as to where the opportunity zones are in Ohio. But generally speaking, it's based on census tract statistics like the poverty rate and the median family income in the census tracts. The same census tract statistics that are used to determine whether a particular site is eligible for new market credits. And so they're trying to encourage investment into those areas. And so what they're doing is for developers, that are doing like a historic rehab project, what the benefits that they can get out of this incentive is that they can get better access to equity capital. So if you need to raise equity from third parties for your your project, particularly obviously if it's included in one of these opportunity zones, you should have a broader pool of potential investors available to you, because this incentive is available to them for investing into those areas, and so might make them interested in investing into your project when they might not otherwise have been, because they're potentially able to get these incentives. Also, it might make your capital less expensive. So to the extent that your investors are able to get a tax benefit for investing into your project, then they might be willing to invest at kind of a lower return, and so maybe you don't have to pay them as high a preferred return or something like that. So that's a second benefit that developers might get out of the incentive. And thirdly is, if you've got a project that involves commercial space, the commercial businesses that locate and rent from your space are able to tap into that incentive also. And so it could make your space more attractive to commercial tenants if your project is in an opportunity zone. So those are the kind of the high level things to be aware of if you've got a project that's in an opportunity zone. Diving down into it a little bit deeper, there are three incentives that were created as part of the program to encourage people to make these investments into the to the distressed low-income areas. By the way, the concept here is that they're trying to encourage people that have investments that they've made, for example, into the stock market. For example, if you put money into the stock market and it went up, they're trying to encourage you to sell investments and then take the gain from those investments and invest it into these low-income areas. And so the first two benefits of the program are really tied to that sale of the other investment that you're generating, the cash investment into the distressed area. So first off, they defer that gain until the end of 2026. So they're saying, if you go trigger a gain in order to free up some cash to invest into a low-income area, we're not going to subject you to tax on that until the end of 2026. And then secondly, when you get to the end of 2026, we're not going to tax you on 100% of it. So depending on how long you've held that investment, you might only have to pay 85 or 90% of the tax on that investment. So those two incentives, again, are tied to the original transaction. But the biggest benefit from the opportunity zone incentive is the third one, which is that investments that you make into the low-income distressed area, if you hold it for 10 years, whenever you sell it, then you don't have to pay any tax on it. And that's obviously a big potential advantage, to never have to pay tax on on a gain. And as we'll talk about kind of in a minute, that's even better than it sounds, because to the extent that you invest in real estate, for example, and you depreciate the real estate and you can claim tax benefits from the depreciation, you don't have to recapture the depreciation when you sell the property either, if you've held it for 10 years at the time you sell it. So for example, if you invest $1 million into a project and it goes up in value and you sell it for $2 million, you've got $1 million of gain from appreciation, but maybe you've depreciated it down to $500,000, and so your gain is really $1.5 million. So you don't have to pay tax on any of the $1.5 million if you've held it for 10 years. So the entire $1 million of appreciation is exempt, as well as the $500,000 of depreciation recapture that you might otherwise have to pay tax on. So obviously that's a big benefit that a lot of people are interested in. This is another example of kind of how the program works. So assume you had some stock that you sold for, and by the way, it could be any type of asset that you sell. It could be real estate, it could be collectibles or art, or stock, or a business you sell. Let's say you sell it for $1.5 million. You had a basis of 500,000, so your gain is $1 million. You have 180 days to invest that into what's called a qualified opportunity fund, and I'll show you kind of how that structure looks here in a second. And you only have to invest the gain. So in this case, you've sold $1.5 million of stock, but you only have to invest $1 million of gain to be able to defer the gain. So if you invest $1 million of gain within 180 days, then you don't have to pay tax on that gain until the end of 2026. And so on the right side of the chart here, you can see what ends up happening is, if you hold the investment for 10 years and then sell it, basically you end up, let's say you sell it for $1.5 million. So you put $1 million into this investment, you sell it for $1.5 million, so you get $500,000 of appreciation. You don't have to pay tax on that $500,000 of appreciation. And you also don't have to pay tax in this example on $150,000 of the original $1 million gain. So you only have to pay tax on $850,000 of the original gain. And on that, you get a deferral of 6 or 7 years on that. So that kind of highlights the benefits here. There's a lot on this chart, but I really just wanted to show you kind of a picture of how the structure works. It's really not that complicated. And there is an alternative structure that can be used, but this is, 90+% of the deals use this structure basically. And so the box on the bottom is basically the real estate project that is being done. So that, that's the entity that owns the property and is rehabbing it, and raising equity. And so they would basically raise their equity through another entity. So basically there has to be another entity involved in the structure, and that entity is the one where the investors put their money into. So rather than the investors put the money directly into the entity that owns the property, they're putting it into a higher tier entity that then invests into the business that owns the real estate. And there's some narrative on this chart. Feel free to kind of go back and look at it. I know you can I believe download this PowerPoint, so feel free to go back and look at that later. But it just kind of outlines some of the requirements that need to be met at each level. So obviously with any tax law incentive, there's technical rules that have to be followed, and that's what the 550 pages of regulations give us guidance on how those work. I'll go through kind of one of those here in a second, but generally speaking, you've got, each level has some sort of responsibility to ensure that they're complying with the rules. The investor, like I said, has to invest their gain within 180 days, and it's got to be capital gain, and so those are the rules they have to follow. The middle box, which is the opportunity fund, has to make sure that 90% of its assets are invested in the right type of property, and they have to file a form with the IRS with their tax return, this form 8996, to certify as an opportunity fund. And finally, the bottom box, which is the qualified business, they've got the most requirements. That they have to have 70% of their tangible property has to be qualified property, which I'll define here in a second. And they've got different other restrictions that come into play. Not generally very difficult to comply with, but you just need to be aware of them to make sure that that you're not tripping up a footfall. The one test that I think is probably worth talking about, though, is just this tangible property test. So they have to basically what they're looking for is new investment into these zones. So they're looking for these, the box on the bottom basically to acquire property after December 31, 2017, which is when this program came into play, from an unrelated party by purchase. And so again, they're kind of looking for new, new investments, basically. And then that would include building a new building, but obviously we're talking about rehabs here. And so interestingly enough, there's very significant overlap between these rules and the historic credit rules. So that the second bullet point under the original use requirement you see here looks a lot like the substantial rehab test that we talked about related to the historic credit. So the historic credit says that you've got to spend more money on qualified costs during a 24-month period to rehab your building in order to qualify for historic credits. Well, this program requires you to spend more money during a 30-month period than your basis at the beginning of the 30-month period in order to qualify for the original use requirement. And so there's substantial overlap there, obviously. If you pass the substantial rehab test for historic credit purposes, you're going to pass the substantial improvement test for the opportunity zone purposes. So basically the building that you're rehabbing and the improvements you're making to it would be considered eligible property, and therefore you'd be able to pass the 70% test that's required at that lower tier level. So that was kind of the point I wanted to make. And so we are seeing a fair amount of projects that are using both opportunity zones and historic credits. Maybe not necessarily the same party, but we're seeing kind of side by side where there's a historic credit investor investing into a project, and then side by side there's opportunity zone investors investing through an opportunity fund. And in theory, you could use it through the same party, but we're seeing more of it on a side-by-side basis. So just real quickly, there's a couple of resources here. State of Ohio has a website with a bunch of information about the Opportunity Zone program, and I think Lucas is going to talk about a credit that's available at the state level for Opportunity Zone investments, and then we've got a resource center available on our website with a bunch of articles and webinars on demand and things related to Opportunity Zones. So I encourage you to check that out if you're interested in more information on Opportunity Zones. And as I mentioned, this is the map of the state of Ohio, which I think is available on the Ohio link that I just had on the last slide. That shows where all the Opportunity Zones are throughout the state. So those are the grayish, bluish areas. So they're all over the state and spread out. So you just have to basically check to make sure your project is in an Opportunity Zone or not. And if it is, then you've got the incentives available that we just talked about. So that is it for my section. I don't know if there's been any questions submitted or not, but happy to answer any questions people may have.
There haven't been any questions put in the box yet, but participants, please try to do that right now if you'd like a little more information. Great,
yeah, I appreciate it. And my email address is on the next slide here too. So if anybody has any questions that they think of after the fact or when they're reviewing the materials, feel free to shoot me an email, and I'm happy to, or give me a call, and I'm happy to answer any questions you may have.
Seeing no questions, why don't we go on to Lucas?
All right. Is that screen sharing with everybody? All
yep,
right.
We're fine.
Okay, good, thank you. So going to walk through, as Gordon outlined, the new market tax credit program, in addition to some various state and local incentives that are available in Ohio. So starting with the new market tax credit, or the NMTC as people call it, this is a federal incentive that's available under section 45D of the code. The credit is equal to 39% of the qualifying investment. That's claimed over a period of 7 years, 5% in the first 3 years, 6% in the subsequent 4 years. It's part of the general business credit under section 38 of the code, as is the historic rehab credit that's been discussed, and a lot of other valuable incentives. The recapture period for this credit is 7 years to match the credit claim period. So investors can't redeem or cash out of their investment. Businesses have to continue to comply with all relevant requirements, and you can't unwind this financing structure for a period of 7 years, generally from your financial closing, or in some instances, maybe a little before that. The eligibility is pretty broad. That's one of the benefits of this program. Generally, any trade or business that's in a low income community can generate new markets tax credits. There are specific exceptions. The most notable is probably residential rental property is not eligible. So if you have a development that's getting less than 20% of its rental income from commercial space, it's not going to be eligible. There are also certain specified sin businesses, as they call them. That's generally things like hot tub facilities, massage parlors, racetracks, or other gambling facilities. Liquor stores are not eligible. Also, golf courses. I'm not sure why golf gets such a bad rap under the code, but this is another example in which it does. The low-income community requirement's actually a lot more expansive than you might think. As Gordon noted a little bit, it's based on census tract data, but many census tracts do fit the bill, so it's certainly something worth exploring. The process to get new markets tax credits is actually, it's highly competitive. They are allocated through the CDFI fund, and certain specified community development entities sort of control the flow of the credits. They are getting a lot more demand than they have credits. So it's a highly competitive process to attract an allocation of NMTCs. We can certainly help with that, or you could talk to Marie. She might be able to direct you in the right direction, but it's a highly competitive process. Generally, projects that generate more jobs or community benefits are going to have a better chance of attracting some allocation. So here I have what's a typical structure for the federal NMTC, and I won't bore the audience walking through every step of this. I guess if you're struggling to sleep over the long weekend, you can refer back to this, but this is what we call the general leverage structure, or AB model. At the end of the day, you can see there's a lot of entities and there is a lot of paperwork involved, but the high level takeaway is from the allocation you're able to attract to your project, you can generally expect, somewhere around 20%, maybe slightly more of that to end up as a subsidy to your project. And it really is, almost free money to the developer as long as they comply with all the relevant requirements. The subsidy it's very valuable if you can attract allocation to your project. So the state of Ohio, as do many other states, has its own new markets tax credit that it largely piggybacks off the federal program. In Ohio, it's administered by the Development Services Agency. It's governed primarily by Revised Code Section 5725.33. Again, the eligibility requirements really just largely mirror the federal program. So if you qualify for the federal credit, you're in almost all instances going to qualify for the state credit. The credit in Ohio is available against the financial institutions tax, taxes on insurance companies, and also the corporate franchise tax. So that's sort of the bucket of investors that you could expect for state NMTC financing. There is a cap for the state credit. You can get a maximum of $1 million in credits for each project. There's also separately a $10 million annual cap that applies statewide. The compliance period and recapture period, it matches the federal program. So if you do a deal with state credits, you're not going to end up with separate unwinds or compliance restrictions. They should match each other nicely. And this is almost in all instances where we see projects funded with the state new markets tax credit. It's going to be paired with the federal new markets tax credit as well. So they work together very well. Next incentive I wanted to touch on is a structured leasing incentive that's available in the state. And the benefit here is that you can leverage sales tax exemptions that are automatically available to government entities. So the incentive is available through port authorities, and it provides the developers the benefit of the port authority's sales tax exemption, primarily for the cost of acquiring construction materials for a real estate project. The general framework here is that the project sponsor will convey to the port a naked fee title, or sometimes a long-term leasehold interest. And that way the port can, as a technical matter, own the project. The project sponsor then typically agrees to act as a construction manager on behalf of the port to actually engage in the construction as they normally would. And then the port leases back in a long-term capital lease the whole facility to the project owner. So really there's a lot of contracts in place, but at the end of the day, it doesn't have that much practical effect on the developer and their construction process. But by transferring naked fee title or a sufficiently long-term leasehold to the port technically becomes the owner of the project for purposes of using its sales tax exemption. These can typically be unwound at any time for sometimes just a nominal or no fee at all. So it's a pretty low risk structure to the developer. They're available not only throughout Ohio, but also in many other states as well have an analogous program. One more incentive I wanted to touch on here is tax increment financing, or TIFs, which exempts properties from real property taxes. And there are probably as many different TIF financing structures as there are municipalities in the state. So this is a very high level simplification, if you will. But the most commonly used one in Ohio is what they call a .41 TIF. It's governed by 5709.41 of the Ohio Revised Code. And it can exempt up to 100% of the improvements from property taxes other than those payable to the school district. And it can be available for up to a 30-year period. Again, the structures can vary, pretty widely from municipality to municipality and from deal to deal. But at a very high level, there are sort of two options. One is a monetized TIF, by which the municipality can make a loan to the project. So you get cash up front, and then you repay that loan with payments in lieu of taxes, which are generally some portion of the taxes you would have owed on the project, but for the TIF. Or alternatively, a non-monetized option, you might just get a more traditional rebate that you're paid semi-annually from your property taxes that would have otherwise been due. Another local tax incentive here is the community reinvestment area tax abatement. So this is another way to get reduced property taxes from your municipality. It also varies widely from place to place. I know here in Cleveland, they have a pretty strong 15-year abatement in Cleveland proper for improvements. They're authorized by 3735.65 through 70 of the Ohio Revised Code. And then they're created at the municipal level through their typical governance process. They create an ordinance that establishes the boundaries of the CRA, and they establish eligibility requirements for your abatement. The maximum, again, is up to 100% of what would be your property taxes can be abated for as long as 15 years. So it's pretty highly variable across jurisdictions, but it can be a pretty valuable incentive. It's not monetized like the TIFs are, as I discussed before, but certainly worth exploring. Another incentive available that's really taken off in the past few years is the property assessed clean energy financing, or PACE financing, as people call it. It's really a public-private partnership involving usually your project sponsor, a third-party lender, and then a municipal corporation or township that creates an energy special improvement district, or ESID, which are popping up more and more. Now a lot of counties have designated the entire county as an ESID, so there's a lot of availability for this incentive. The general framework is it's a loan program. A lender makes a loan to the property owner specifically to finance improvements that increase the energy efficiency of the project. It can take a variety of forms. The lender can be public or private. It's pretty flexible. The PACE program allows the municipal corporation or township to levy a special assessment on the property, and that's the security for the loan. So that's really the primary benefit. I mean, that in and of itself can create a lot more structural flexibility. You might get some favorable terms, typically not way below market interest rates on these loans. The real prime benefit is that it's, as non-recourse gets. The security is just this special assessment. Even if they went through a tax lien foreclosure process, they could only claim what they were owed in each year. So it's very favorable in that regard. You might get a break on terms, but it's not going to be way below market like a loan you would get from a NMTC financing, for instance. Also wanted to touch on JobsOhio. I'm sure many people are at least somewhat familiar. They offer really a wide variety of incentive packages for projects throughout the state. They have different low interest loan products and also just give grants to job creating projects. Loans can be acquired up to $5.5 million. They typically have a 10-year repayment term on pretty favorable rates. Grants, you typically see either $500,000 or $1 million. As the name implies, of course, it is job oriented. So your project has to generate at least 20 new jobs to qualify. There could be additional workforce development requirements as well. That's something that really varies from project to project. But certainly worth checking with JobsOhio. If you're developing a new project that will create at least 20 new jobs, they have some pretty valuable incentives. Next topic, wanted to talk about the Ohio Water Development Authority. It's a component of the Ohio EPA. They really have many different loan programs available. Wanted to touch here on the alternative stormwater infrastructure loan program. It provides below market loans for the design and construction of green infrastructure as part of larger projects. So think about things like green roofs or bioswales, those sort of improvements that trap and filter stormwater is really the wheelhouse of this program. You can get up to $5 million in loan funds per project. It's done through governmental agencies. So a private developer can access the funds by partnering with a governmental entity, but the initial applicant for the incentive has to be a governmental entity. So that's one bit of a quirk about this program. Again, the funds can be used to design and construct these types of stormwater capture improvements. It's also available, though you can use it for soft costs. So, I mean, within that limited use, it's pretty broad applicability to defray costs of your project. The process for applying with these starts with the Department of Development, then they help shepherd it to eventually get approved by the OWDA board. Again, have to partner though initially with a governmental entity to get that started. Another valuable incentive here in the state is the Ohio Brownfield Fund. This is another one that's administered by ODSA, the Development Services Agency. They can provide loans up to $500,000 just to get your phase 2 environmental site assessment. If you get a phase 1, that indicates you got some wrecks that you might have to deal with. They might cover almost all your phase 2. And then you can get up to $5 million for actual costs of your remediation, including demo and cleanup of existing hazardous substances, asbestos and lead-based paint, which you'll see in a lot of older buildings. If you're doing a rehab, you might have to deal with some of that. You can get up to a 10-year repayment term, and they're very favorable rates below market. Job creation for this is not a requirement, although it is a competitive process. And if you do have a project that's going to create a lot of jobs, you might be given more favorable treatment. You can get more information on how to apply in the application materials themselves on the ODSA website for the Brownfield Fund. So as Gordon outlined, I'm going to touch on the Ohio Opportunity Zone tax credit. Many states, after the OZ program was passed and the Tax Cuts and Jobs Act, tried to create some sort of incentive to match those federal investments. So this is another one that's administered by ODSA. It's governed primarily by Ohio Revised Code section 122.84. And what they did in Ohio was create a credit to sort of piggyback on the federal OZ incentive that Gordon outlined. So taxpayers that invest in Ohio qualified opportunity funds can apply for a non-refundable credit against individual income taxes. That's the only tax that you can use this credit against. So it's not as readily syndicated as some of the other incentives we've outlined. But bear in mind that to apply for this credit, the deadline is February following the year of your investment. So if you make a federal OZ investment in Ohio, the clock will start ticking that next year, and you got to complete it within the month of January to apply for this individual credit. And there's a statewide limit of $50 million per fiscal biennium. There's also an individual limit of $1 million per fiscal biennium for each taxpayer. So that does create a bit of a race. So again, bear in mind, if you make an OZ investment in Ohio, the clock will be ticking when the calendar turns to get that application in for the individual credit. You can carry the credit forward against your individual income taxes for 5 years, but again, it's not refundable, but you can transfer it one time to another taxpayer. So that creates some flexibility on the use if you don't have enough income to defray. Last topic wanted to touch on, and it's been pending for a while now, but the transformational mixed use development credit, or TMUD, is a lot easier to say. It's in Senate Bill 39, which again is still pending. It would provide for a credit against insurance premium taxes in the amount of 10% of the development costs for eligible transformational mixed use development projects. So it's targeted at really large scale developments, and it would be limited. This is one of the things that's been evolving as this passes through Congress, but most recently maybe limited to 4 projects per year. So it'd be more limited to a very big project, but could be a very valuable incentive. And again, being applied against insurance tax is really designed to be syndicated more like the HTC than the opportunity zone credit. So it would be monetized through sale again to insurance companies like the state HTC. It's pending now in Senate Bill 39. It was passed by the Senate, but it's back in the House, and it's been sort of batted around for a while now, but people are still, hopeful it should be passed soon. So you have to stay tuned for more developments, as it's now again still currently pending, but prospects are good. So that was all the slide deck. I don't know if any questions have come up.
We don't have any questions yet, but people, this is a great opportunity to get some what would be expensive advice you can get for free right now. I would type your question in. I have one question maybe that I can share. We have a lot of participants who are from what I refer to as courthouse-sized communities, and they don't always feel that new markets credits and things like that are available to them. Do you want to talk about someone answer to the scale question of projects for these various incentives?
Yeah, that's a great point. I mean, I think new markets in particular, a small community project really does have a good chance. I mean, it might not make sense if you have a project that's, less than $5 million maybe to go through that financing, because it is a lot of paperwork and headache to put the structure in place. But to the extent you have a development project in a small town that's a qualifying community, that could be very attractive to the CDEs that sort of shepherd the allocation of those credits. So it's sort of a push-pull. If the project's too small, it might not make sense to tie it down in that structure. But if you have a good project in a smaller community, it could be really attractive and be able to draw that allocation and be a really valuable incentive.
So you kind of use $5 million as a guide?
Yeah, and it varies. Different CDs offer different products. Maybe like there are some that offer revolving loan funds for smaller deals like that. If you wanted to do a traditional leverage structure for one deal like I outlined, I would maybe put that in the ballpark of the limit, but there are other options available.
Yeah, there's been a push lately at the federal level to be creative for coming up with programs to finance small projects and other non-traditional kind of investments. And so I think the hope is that over time that'll be more workable, and I think that is happening gradually. But I would agree it's probably more challenging for a smaller project to be able to use that program in particular than bigger projects.
Right, and one resource would be the Summit County Port Authority. They have a community development entity that applies for new market tax credits. And in the past, they have used a portion of their awards for the innovative small clickies, which in the past has been an investment $2 million or less. And the most recent round, it was increased to $4 million or less, because the CDFI fund has recognized that this is an issue that smaller communities deal with. So I know the Summit County Port, they just received a recent award. I'm not sure, they did not receive a recent award. They're working on their pipeline currently for the next application, which we're anticipating to be released in the next month or so, and then submitted probably by the end of the year. So that might be something to reach out to. Again, that's Summit County Port Authority. Their CDEs is the Development Fund of the Western Reserve, to see if they might be doing a small clicky loan fund for their next application.
And do they have geographic boundaries or restraints?
So they are in Summit County, but they cover many counties. I want to say from, I know they include Lorain County, and then they go all the way down to like the West Virginia border. So it's a vast geographic area. It does not include Cuyahoga County because they want to focus on some smaller communities.
And another potential resource is the National Trust for Historic Preservation. They've got a for-profit subsidiary, the National Trust Community Investment Corporation, and they've been very successful at receiving awards in the past. And I'm pretty sure they just got one this round that was announced a month or so and they do typically carve out part of their award for small projects, and so that would be another place to go, particularly for obviously they're focused on historic rehab projects, but that's what we're talking about here. So that would be another place to go look for possibly new market credits for smaller projects.
I see no other questions. Marie, do you want to go on with your presentation?
Sure. So again, my name is Marie Hickel. I unfortunately do not have any slides, but I wanted to provide my email address, and I'll try and provide it at the end also if I can remember. It's marie.hickel@pnc.com. So feel free to reach out if you have any questions. So my role here at PNC is I'm a relationship manager with our specialty tax credit division, which covers new market tax credits and historic tax credits. So PNC's role is we act as an investor in these type of tax credit transactions. So we will invest the bank's equity into these transactions in exchange for the tax credit subsidy that we can apply to our tax liability. PNC also can act as a lender in these transactions. That's not in my part of the group, but we would look to community development banking or possibly real estate banking. There's other groups in our commercial and institutional banking divisions like business banking or commercial banking we sometimes see come across. But unfortunately, when we're talking about historic tax credit investments, with PNC putting their equity in, some at closing and then the other equity delayed, we do not provide historic tax credit bridge loans. So that's one product that we do not offer. But we do also, in addition to investing in historic tax credit transactions, we do syndications also, where we would close a transaction and either have an investor that we would close it for at the time of closing, or we can close it and then syndicate it to other investors, which helps us, not necessarily for Ohio, but geographically expand our footprint. So we do have a large footprint in the state of Ohio. With PNC acquiring National City back in 2008, there's a large presence in Cleveland and Cincinnati. So we do see a lot of activity in the state of Ohio. Another product that we have is our Opportunity Zone Fund. This is a unique product that PNC has really been kind of on the forefront on when it comes to institutional investors, where typically what Gordon was talking about would be individual investors and their capital gains. So PNC has developed a successful program that has been almost oversubscribed, and it's run by our community development banking group. Some qualifications for these projects that it must be CRA qualified. That's just something within community development banking. They decided, they didn't want to just do projects that were in an opportunity zone. They wanted to make sure that they were projects that were impacting the communities in a positive light. And then also the product is unique where there is an opportunity zone investment, but in order for PNC to perfect their collateral and their interest, there's also a debt requirement. So the way that these typically deals will look is that there's a 10% developer equity requirement. So for example, a $10 million project, we would see about at least $1 million in developer equity. There'd be a 70% opportunity zone investment or 7 million, and then 20% or 2 million would be PNC debt coming from community development banking. And one of the benefits to this is that it's very low interest rate. The loans are a very low interest rate, but then the opportunity zone expected return is in like the 4 to 6% range, which is incredibly low for equity investments when you would be going typically without an opportunity zone, fund or program out into a market where you would be seeing, at least 12% requirements. And that would be, pretty low. That would be an investor that would be, wanting to do community development type of projects. So that is one of the reasons why PNC's program has been so successful, because of the low return requirements that are required for that financing. Some other topics I want to discuss is, because we are all virtual and I am in my extra bedroom / office, is some of the implications that this COVID pandemic has had on these types of investments. So for example, with historic tax credits, we have seen investor demand shift significantly. I think we all know the economy has been doing well for a long time. And with this pandemic, we have seen investor interest scale back. That has really impacted our syndications business on both the historic tax credit and the low-income housing tax credit. And because this investor demand has decreased related to banks reevaluating their tax credit, or I'm sorry, their tax liability for this year, they're expecting that it will decrease. So then therefore they don't need as many tax credits for this calendar year. We have seen pricing drop. We've seen this over all of the tax credits projects, the historic tax credit, the low-income housing, and the new markets. And so some of the things that have also changed is that with projects in construction, we have been seeing delays triggered by mandatory work stoppages, supply chain disruptions, labor shortages, and other factors that are leading to cost overruns and potential delays in the credit delivery. When it comes to, and that's for projects that are already under construction. There's also concerns for new projects when we're looking at projects that are looking to close their financing in this environment. We're hoping to, see increased contingencies. Typically we would require, for a historic rehab, maybe a 10% contingency. And then after we get a third-party plan and cost review, we could, based on their expert opinion, we could see that being decreased maybe down to 5%. But now we're seeing increased contingencies in a range of 10 to 20% to cover any of these cost overruns, to just mitigate circumstances for the increased cost overages that could be related to some of these COVID delays. We're also seeing longer construction periods because of some of these slowdowns and work stoppages, also the supply chain issues. So we want to make sure that there's adequate reserves when it comes to paying interest, fees, operating reserves, and then also stress testing these reserves to make sure they're adequately sized and correctly spent in the projections. We're also evaluating holdbacks when it comes to payment for developer fees, fixtures, furniture, and equipment, working capital, and other kind of reserves that might need to be held until project completion. When it comes to contracts and bids, we do have a construction review team that helps us with this, but we're seeing that, because some contractors and subcontractors were delayed and they have, we're seeing just even the whole process of bidding being delayed and the cost of construction going up. And this is related just to general contractor capacity, with their manpower. We have seen with work stoppages. Now, the state of Ohio didn't necessarily experience this, but I also cover Pennsylvania, and there was a statewide mandate to stop work. And then once that was released, some projects experienced that certain unions, because of their unemployment benefits and then the additional $600 from the federal government, some unions were not wanting to come back to the site. So that was something that, the contractors and the projects had to deal with. And, how could they potentially, work around those inconveniences. When it comes to general contractors, we thoroughly underwrite their financial capacity and their current workload, just to make sure that, the projects that we're looking at are going to, remain a priority and will get done. Also, what are the work site conditions and are there any supply chain issues? When it comes to payment and performance bonding, this is something that, in the past we have been able to waive based on, the contractor's financial wherewithal, their experience. This is something we're getting a little bit more strict on. We also look at the sponsor or guarantor capacity for any potential cost overruns. Because with these projects, we do have a construction completion guarantee. So we need to look that, at their personal the company's financial statements. We always will, look to evidence their liquidity through bank or broker statements. We want to evaluate contingent liability schedules. And then we might, impose liquidity covenants or cash secured guarantees when required. We will typically we've done site visits in the past. It's very interesting that companies have gotten very creative with, the use of FaceTime and Zoom services like this in order to get site visits completed with, while remaining remote working. There's also a lot of COVID work plans that just take precautions during the pandemics that we're seeing are increasing costs for the project, but it's just something that these projects, they have to do in order to remain compliant. And I think, at least from my experience and working with our asset management team, projects have been very successful with managing the transfer of this virus. And so we haven't had any issues where there's been outbreaks on construction sites, which is very, very promising. So that is some of the concerns that we have when it comes to projects that we're considering for future investment. When it comes to the current environment, we again are looking at, for projects under construction, sponsor liquidity and access to capital. What is a developer's cash burn rate? An example, how long can they survive? Again, what are their contingent liabilities? What are their other properties looking like? And, analyzing their leverage, their cash flow, their near-term debt maturities, and then the ability of project level reserves to alleviate out-of-pocket cash infusions the sponsor might have to utilize. So with the projects that are under construction, we're, again, seeing work stoppages, these disruptions. Some of the issues that we look at there are, with the projects under construction is the budget. There's going to be some cost increases that would not be covered by the general contractor. So there's provisions for bonding. And we always make sure that that's the sponsor's obligation for the excess development costs. In our operating agreement, we always require the budgets to remain in balance at all times. So, if we anticipate that there's, changes to the budget and we need to see that the sponsor can come up with those funds, there is potential for events of default. But we are, really trying to work with our sponsors in order to create kind of a more synergetic type of environment where we're willing to work with the sponsors and get creative. Could it be, funding additional equity or whatnot, or helping them connect with another division of our bank to maybe get a line of credit. We also look at holdbacks. So the sponsor may request, as I said, an acceleration of PNC's funding of their equity to alleviate some of the impacts of the budget's increase. So that's just something we have to consider. And again, we look at, the financial wherewithal of the developers and their track record in our relationship. There are tax credit adjusters. So when we're looking at changes in the budgets, we need to consider, what the change is. Typically we're going to see an increase at this point, the placed in service date, and any obligations to fund additional capital for these credit adjustments. And so we have, with the historic tax credit, upward adjusters, and under the Rev Proc, a minimum of 20% is expected of the HTC equity investment must be funded prior to placed in service. So therefore, our upward adjuster is capped at 20%. We have a downward adjuster that's capped at 25% because of the Rev Proc rules, which requires 75% of the investor's capital to be fixed in an amount. And then with the delays that we're experiencing, our expected credit delivery has been impacted. So, we've got a lot of requests for, relieving some of the implications that go with that, with, specifically the delays. We have agreements in our operating agreement that could trigger certain decreases in the amount that we pay per credit for any delays. We have repurchase options. And another issue that we've seen with the construction is force majeure, where sponsors may claim COVID-related delays as force majeure. So those are things that we're considering when it comes to projects that are currently under construction. We have also been contacting our projects and having them complete a COVID questionnaire for the sponsor and the general contractor. And a lot of these questions deal with, you know, are there any current or pending work stoppages? What is the GC's experience with the slowdowns and staffing of other projects? Again, the supply chain is a big concern. You know, what are they doing on the site? So those are all things that we like to maintain contact with our developers because of these concerns. So we're making sure that we stay on top of, you know, any issues that projects are having, and we can, you know, certainly hope to be of service to them as a resource when they come across issues. The other types of projects we have that are already under operation. And so again, mandatory shutdowns, the decreased demand for services and other disruptions. You know, we're seeing that this is especially impacting the operations for completed projects, but it's mostly impacting hotels and retail that are taking these immediate hits, leading to requests for deferrals and loan modifications. So we actually have started having like weekly asset management calls where, you know, we're talking with these projects about the issues they're having and how we can, you know, help them deal with some of the issues. Some of the main issues that we are addressing is just NOI and debt service, because we're seeing a lot of these projects, their NOIs are, you know, not as high as they used to be. And there's some debt service coverage requirements. So we're having to identify, you know, is this specifically something, you know, related to COVID, or is there some additional operating issues that were going on previously to this and it's been mismanaged, and so now it's just magnified because of this pandemic. So, you know, we're having to dig into, you know, almost perform audits of these organizations to see, you know, exactly how, you know, they have dealt with this situation. And again, it's, you know, specifically, we're dealing with a lot of hotels and the retail component. The Paycheck Protection Program loans. We have had a lot of businesses apply for these loans. And because we are in these historic tax credit projects, sometimes the owner or, you know, an entity involved, we have to grant permission for them to take on additional debt. So that is something that we have been managing through this process and just making sure that the projects can actually support this debt, you know, when there is a potential portion that has to be repaid, and are they getting it for the right reasons? Other things that we look at from our investments is that when we price as an investment, we will pay an upfront price, but then we expect a preferred return. And then in order to remain compliant with the RevPRAC, we look for residual cash flow. And then there's a put payment, and then there's at the end, which is at our option, but then we also evaluate the fair market value. So we understand that, you know, these businesses are being impacted, so they might not be generating as much cash, and therefore can they continue to pay the cash receipts that we expected, and especially on exit, do they have enough funds to pay the put price for the exit, or does that need to be renegotiated? And so we can look at, you know, how has our relationship been with the developer, and, you know, what has our return been compared to what we anticipated, and so that kind of helps us make the decision. So there's a lot of conversations about the relationships, because we know that this is a tough time for you know, so many businesses, so many developers, and it's a tough time for us too. So we just like to keep the lines of communication open, and, you know, be understanding of the situations. When it comes to lender issues, because we are the historic investor on these projects and we're not the lender, we're also dealing with the lenders. So the lenders are being asked for, you know, deferrals, modifications, potential foreclosures, and then if projects are at the end of their compliance period, we're also looking at loan maturities. And if you're looking at, the debt service coverage and NOI, it's going to be difficult for some of these projects that are coming up on their loan maturities to get refinancing. So again, we're working with the lenders also. When we're talking about the historic tax credits for a project that's recently placed in service, we're also working with bridge lenders that are bridging our historic tax credit equity. So if there are timing delays and the placed in service is delayed, then our equity investment is delayed, and they might have let's say a 36-month term, and we're pushing that term limit. And so they would be able to call for their repayment, but we have not yet put our equity investment in. So again, we're working with, just not the permanent lenders, but the bridge lenders also. So these are just some of the issues that we're dealing with when it comes to the COVID impacts that we're experiencing at this time. As I mentioned, hospitality and retail has taken the biggest hit. So currently, when it comes to projects that we're evaluating for future investments, all of PNC as a whole, not just our tax credit group, but like real estate banking and community development banking, we are not considering hotel and hospitality anchored projects anymore. And, unfortunately, there's been a lot out there just because of the way the economy has been going. One of the discussions we're having for projects that, let's say, are in the closing process, or we've been talking with for a long time, if it's office space and they say we've, been having conversations with this company and, we're discussing this lease, we are encouraging them to get that lease signed quickly. Because as we know, many of us are working from home remotely, and I think we're all doing it pretty successfully. So companies are going to have to identify, are we going to have workers return to the office? And then with this extended period of time, are employees going to say, well, I want to be able to work from home 4 days a week, or be able to go into the office for just meetings? And so will companies need as much office space as they did in the past? So that's one big concern when it comes to residential projects, especially in downtown areas. Downtown areas have experienced a surge in demand just because of the amenities that are offered and, being close to work. And so with a lot of these events not going on, will the demand remain as high? What will lease up look like for newer properties? So these are all the types of questions we're asking ourselves when we're looking at new transactions. And it's difficult because, typically we can rely on market intel, third-party market studies and appraisals, and these professionals are in the same situation where they're asking a lot of questions and there's really not clear answers, and we're probably not going to know them for a while until some of this pandemic starts to clear up and there's a possible vaccine. So those are what we're dealing with from the COVID impacts to our business, underwriting, and what we're looking at for projects that are new projects under construction, and then operating projects. So are there any questions on what I covered?
That's a lot of information. So let's give some people some time to put some questions in. We did have one come in from Sandra, and I'll read the question first. And I think, again, there's so much information, we might have to apply it a couple of ways. Would the next step to using this information be to forward it to our downtown investors and their CPAs? And I wonder if maybe that question should be addressed to opportunity zones first. Which comes first, the project or the investors?
That's a good question. I think it's probably the key is just education and making people aware of what the program is. I guess whether it's historic credits or opportunity zones or any of the other programs we've talked about is the more that developers are aware that the program exists, and I guess in this case also the more that investors are aware that the program exists, then and how it works, the more likely it is that it'll be able to be used to help projects succeed. And so I guess I would just encourage education as possible, and to the extent that there are parties out there, and I'm certainly certain that there are, whether they be investors other developers that could use more education, I think it makes sense to try to get them that information, maybe get them plugged into this, the recording of this webinar and or the materials, and then they can follow up with, either any of our panelists here at their convenience to, to talk about how it might apply to them. So I guess that would be my thought.
Great, thank you. Other questions to come in? Well, wait,
one thing I just want to add, maybe while we wait and see if there's more questions, is on Marie's presentation, just a couple things. One is it seemed pretty clear that one of the keys is communication, with your store credit investor and your lenders, and being upfront about what's going on with your project, and things like the delays and how that's going to affect the timing of the equity pay-in and the bridge loan, and just making sure that I'm getting a lot of calls from clients that are wondering, am I going to get hit with this adjuster, and how's this going to affect me, and is that going to create a gap in my project? And I'm just encouraging them to communicate, with their investor and lender, and and try to work it out, and hopefully they, they can kind of work something out together, as opposed to just putting it under the rug and dealing with it later. I mean, that doesn't seem like a great strategy. So the other thing I just wanted to point out is with respect to loan modifications, which is one thing that Marie mentioned, there can be some tax implications there if you modify loan terms, not always, but in some cases, depending on how significant the changes are, it could create cancellation of debt income, and that could create another problem where you've got some, I guess what I call phantom income, where you've got taxable income that you don't have cash associated with it. And so you want to be careful if you're in the process of negotiating changes to loan terms, to maybe talk to your CPA about that before you finalize anything, to try to understand, might this change that you're talking about trigger cancellation of debt income, and is there anything you could do to modify the terms of what you're talking about to maybe avoid that? So that's worth reminding everybody about.
Okay, great. We also have another question that has come in from Aaron. Hospitality and office are obviously risky end uses in the COVID world. What feels like safe investment?
So right now, we know that grocery stores are doing well. They're hiring. Anything in like the food realm, growing food, food production, food delivery, which it's been very interesting because, you would think that would be somewhat hospitality. They would be viewed as hospitality, but this is more of the delivery services that I know a lot of people are using. And we've just seen a surge in, that type of service demand. And I think a lot of people through this whole process, they're saying, they're doing it for, because it's essential to not, take their kids to the grocery store and potentially expose themselves. But there's also a convenience factor to it. So I think that's something that's going to stick around for a while. If you can have someone do your grocery shopping for you, and you can pull up and have them put it in your car or deliver it to your house, that's something that's going to probably stick around for a while. Also, we're seeing, a lot of the, unfortunately, the biggest companies like Amazon and Walmart that are doing good. So, we're going to see that there's going to be a lot of the warehouse space that is going to be in higher demand than it has been in the past. And so again, that, goes back to the type of, convenience and delivery of goods and services that, everyone is experiencing at this time. So unfortunately, those probably aren't, the businesses that, we would think of when it comes to community development, when we're thinking about small businesses and businesses in the communities. But I think that's what we're seeing right now. And I think it'll take time to figure out, how small businesses can adapt to compete with some of these larger businesses. Because I think a lot of people want to support the small businesses, and they might just not be out there at this point, but there's the ability for businesses to market their services and fill some of these gaps that people are looking for.
As long as we're talking about that demand, do you also want to address, oh, I'm sorry, Gordon, finish first. Yes.
Yeah, I just wanted to quickly say, it seems like multifamily is still doing pretty well too on the residential side. That you know we're you know they didn't get hit as bad as some of the commercial, particularly the hospitality and retail. And so you know we're seem to see like the projects that are kind of getting back on their feet quickest seem to be the ones that have a significant multifamily component to them.
That's exactly what I was going to ask, addressing upper floor housing and buildings. Any other questions to come in? We're at 11:30, so that's our 90 minutes. Again, this session, with all of these incentives, watch it twice. You know, the recording's available to all the conference goers. Thank you all. Thank you, Gordon, Lucas, Marie, very much for the information. We have, again, if you're an architect and want the 1.5 HSW, please write office manager at heritageohio.org. Include your AIA membership number with that request. Our very last conference session will be at 2 o'clock today. It'll be a lot of fun. Not so much technical information like this session. We will be zooming through history with Kevin Rose in Springfield. So please join us then. And again, thank you to Plant Moran, Baker Hofstetter, and PNC for this information. We appreciate it. Goodbye.
Thank you.
Thank you.